Hey everyone, welcome back to Corporate Decoder, where we turn those dense SEC filings into something you can actually understand. Because diving into financial reports shouldn't require a finance degree. And today we've got some juicy numbers from Cohen and Steers, Preferred Securities, and Income Fund Inc. They just dropped their semi-annual report, and let's just say there are some interesting trends hiding in plain sight. Don't forget to hit that subscribe button and check out our Discord community linked in the description if you love breaking down corporate insights live. Alright, so this filing is a look at Cohen and Steers, Preferred Securities, and Income Fund Inc. for the period ending June 30, 2025. Think of it as a financial checkup for this investment fund. First off, let's talk about costs. For a hypothetical $10,000 investment in their Class A shares, the costs over the last 6 months were $57. To put that in perspective, that's about 1.13% on an annualized basis. If you're in Class C shares, that cost shot up to $90 or 1.78% annualized, which is quite a bit higher. This just shows how important share class choice can be for your investment returns. Now for the performance, the Class A shares actually returned 3.26% over these 6 months. That sounds pretty decent, right? But their benchmark, the linked blended benchmark, did a little better at 3.35%. So while they made money, they slightly lagged behind their target. The ICE US All Capital Securities Index, another benchmark, returned 2.43%. So they beat that one. What made this happen? Their strategy included having more money in non-US bank issues, which appears to have worked out well. They also invested in some high coupon euro-denominated securities, which benefited from the European Central Bank cutting interest rates. They also did well in US banks and insurance sectors. On the flip side, their investments in utilities and pipelines didn't perform as well. It seems some California utility companies underperformed due to wildfire concerns, creating uncertainty. They also use something called total return swaps to manage risk. While these are generally good for protection, they did cost the fund a bit of performance. Let's look at the long-term growth of a $10,000 investment. If you had invested in Class A shares in mid-25th, by June 2025, you'd have about $14,800. That's a decent growth, but the linked blended benchmark actually grew even more, reaching over $15,700 in the same period. This highlights that even with a solid return, there's always room for improvement compared to the benchmarks. Looking at annualized returns, Class A shares without sales charges delivered about 8.28% over 1 year. Over 5 years, it was around 3.70%, and over 10 years, about 4.41%. Again, the linked blended benchmark consistently outperformed these numbers over the longer terms. Now, where is all this money actually invested? Let's peek at the top 10 holdings as of June 30. The biggest chunk, 1.3%, is in Goldman Sachs Group Inc., followed closely by Citigroup Inc. at another 1.3%. Then we see familiar names like BNP Paribas, Charles Schwab, MetLife, UBS, Barclays, and Bank of America, reflecting that heavy focus on the banking sector. This is a clear sign of their strategy, leaning heavily into financial institutions. And speaking of sectors, the overwhelming majority of the fund's money, 55.9%, is in banking. Insurance makes up another 13.2%, and utilities around 12.2%. This confirms that very concentrated bet, especially on banks. Geographically, the United States is the largest holding at 46.3%, followed by Canada at 12.9% and the United Kingdom at 9.0%. So while they invest globally, the US is still the dominant market for them. The total net assets for the fund are a massive 7,514 and 33,208. That's over $7.5 billion, quite a chunk of change. Looking at the statement of operations for the 6 months ending June 30, 2025, the fund saw an unrealized appreciation on its investments in securities of over $120 million. That's a positive sign, showing that the underlying value of their holdings is growing. However, if we look at the financial highlights for Class A shares, the net asset value at the beginning of the period in 2025 was $12.27 and it ended at $12.34. That's a pretty small increase. So while the investments themselves gained value, the overall net asset value per share didn't jump dramatically. This is often due to distributions paid out to shareholders, which reduce the NAV. With Class A shares showing a 3.26% total return for that 6-month period, it aligns with what we saw earlier. It's important to remember this return doesn't include sales charges, which can make a difference. What's your take on these figures and this investment strategy? Drop your thoughts in the comments below. If this deep dive was helpful, give us a thumbs up and subscribe for more corporate breakdowns. And hey, join our Discord community too, linked in the description for even more engaging discussion. Thanks for watching. See you next time.